Chapter 1. The Morning Perfection. Died. Some cities fall slowly. Wars, riots, debt crises, revolutions, messy stuff, photogenic stuff. Singapore didn't get that luxury. Singapore woke up one morning and discovered it had been administratively perfected to death. Overnight, the global markets were informed that Japan had formally absorbed Singapore. No tanks, no sirens, just a press release, 3 spreadsheets, and a bow so deep it cracked the floor. The headlines were polite. The numbers were not. The first thing to die. Confidence. At 9 a.m., the Singapore Exchange opened. At 9:01 a.m., traders realized something fundamental had changed. Singapore assets were no longer Singaporean. They were now Japanese adjacent. That subtle shift mattered more than war. Funds that once marketed Singapore's stability quietly updated their risk models. Japan's balance sheet entered the room like an elderly relative nobody wanted to talk about. Debt ratios, yield curves, demographic projections shaped like cliffs. Within hours, blue-chip Singapore stocks were repriced as regional exposure. Sovereign-linked entities lost their premium foreign capital, paused, blinked twice, and slowly backed away. Markets don't panic loudly. They just stop believing, and belief is the only real currency. Real estate, from safe haven to spreadsheet. Era Singapore property had one religion: scarcity, limited land, endless demand, prices that only moved in one direction, preferably upward. Then Tokyo entered the chat. Suddenly, Singapore real estate wasn't rare, it was redundant. Japanese planners did what they do best: optimize. They compared. Tokyo suburbs with higher density Osaka commercial districts with better yields, regional Japanese cities begging for population inflow, and they asked the unthinkable question: why is this so expensive? Developers froze. Foreign buyers hesitated. Banks quietly revised loan-to-value ratios. Condos that once sold on floor plans alone now needed discounts. Actual discounts. The kind that cause panic WhatsApp messages in property chat groups. The myth cracked. Stocks, savings, and the illusion of control Singaporeans were taught a simple story: work hard, save diligently, invest wisely, retire comfortably. Japan brought a different narrative: work hard, save nothing, invest carefully, survive. CPF-style certainty dissolved into Japanese-style caution. Low yields became lower. Safe instruments became long-term considerations. Retail investors stared at portfolios that hadn't technically crashed, but felt emotionally erased. Nothing collapsed. Everything just felt smaller. That's worse. The psychological shock. The scariest part wasn't financial, it was existential. Singaporeans had always believed they were neutral, efficient, globally trusted, above regional chaos. Now they were a department, a well-run one, a polite one, but no longer the final authority over their own balance sheet. Perfection had been absorbed, and before you scroll away. If this opening made you uncomfortable, good. Discomfort is where clicks are born and ad rates rise. This series will dismantle stocks that stopped being safe, property that stopped being sacred, cash that stopped feeling sovereign. If you care about money, power, or watching perfect systems fail politely, subscribe. If you enjoy financial anxiety packaged as satire, like this video. Chapter 2. When money realized it was Japanese. Now the collapse didn't announce itself with flames. It arrived dressed as policy alignment. Singapore was told nothing fundamental would change. Same efficiency, same safety, same rules. Just oversight. Markets love that word. Oversight means someone else owns the panic. The yen problem. Nobody wanted to say out loud. The moment Singapore was absorbed, one silent question poisoned every trading desk. Is Singapore money still Singapore money? Because now it sat under the gravitational pull of the Bank of Japan. A central bank famous for one thing only: printing calm until calm dies of exhaustion. Japanese-style monetary policy arrived gently. Rates that stay low forever, liquidity that never leaves inflation that is officially temporary for decades. Singapore's former reputation for tight discipline dissolved into strategic patience, which is what governments say when they have no exit. Foreign funds recalculated again, not dramatically, quietly, the most dangerous way. Stocks didn't crash, they aged 20 years. Overnight, Singapore equities had once traded like a future. Now they traded like a retirement plan. Dividends replaced growth stories. Innovation decks were replaced by governance slides. Japanese institutional logic took over. Stability over ambition, employment over efficiency, survival over returns. Investors noticed something disturbing. Nothing was wrong. Nothing was exciting either. That's when capital leaves. Real estate enters the Japanese time loop. Then came zoning reviews, density studies, long-term demographic projections that showed fewer babies than parking spaces. Japanese planners looked at Singapore housing and asked, who will live here in 30 years? That question alone shaved billions off paper value. Mortgage terms tightened. Speculative demand evaporated. Developers stopped launching and started praying. Prices didn't collapse, they stagnated, which in leveraged societies is the same thing, just slower and crueler. Savings became a museum exhibit. Singaporeans loved numbers going up, CPF balances, portfolio charts, property valuations. Japan introduced a new aesthetic, flatness. Savings still existed. They just stopped doing anything interesting. Returns barely beat inflation. Sometimes they didn't even try. People worked longer, saved harder, and somehow felt poorer. That's the Japanese miracle. The middle class feels the floor drop. Nobody rioted, nobody protested. They just stopped upgrading phones, stopped eating out, stopped believing the next promotion mattered. Middle managers realized their careers had peaked quietly. Young professionals realized ambition had an expiration date. Singapore had imported Japan's most dangerous export, acceptance, and let's be clear. This is not anti-Japan, this is anti-illusion. Japan didn't destroy Singapore, it normalized it. If this chapter made you uncomfortable, hit like. Chapter 3. The Day Foreign Capital Left. Without saying goodbye, capital never waves. It doesn't pack boxes. It doesn't announce relocation plans on LinkedIn. It just goes silent. And silence, in finance, is death. The spreadsheet that killed the party. The first thing global funds did after the absorption was brutally boring. They updated one line in a model. Country risk, Singapore, Japan, adjusted. That was it. No conspiracy, no drama, just math quietly deciding your future. Japan's demographic curve entered the calculation. Its debt load sat there like an unpaid credit card. Its growth assumptions were so low they needed subtitles. Singapore's old premium vanished in one keystroke. FX traders smelled blood. Currency desks reacted before politicians finished smiling for photos. Singapore dollar logic used to be simple. Strong governance, fiscal discipline, predictability. Now it floated in the shadow of the yen. And the yen, courtesy of the Bank of Japan, had become a lifestyle choice rather than a currency. Carry trades adjusted. Hedging costs rose. Volatility crept in like mold. Nobody shorted aggressively. That would be rude. They just stopped holding. Funds didn't sell. They reclassified. This part hurt the most. Foreign investors didn't dump Singapore assets. Dumping causes headlines. They did something colder. They reclassified. Singapore equities moved from core Asia allocation to developed market exposure. That sounds neutral. It isn't. Developed market exposure means lower growth expectations, lower valuation multiples, less forgiveness for mistakes. Money didn't flee in panic. It failed to renew interest. That's how capital flight works now. No exits, just expired invitations. Property investors. Found the exit. Too narrow. Luxury property had been Singapore's unofficial reserve currency. Safe, prestigious, liquid. Until Japanese-style holding periods entered the conversation. Foreign buyers suddenly faced longer approval timelines, regulatory reviews, demographic arguments about long-term utility. Nothing kills luxury faster than utility. Units sat unsold, rent guarantees disappeared, yields fell below government bonds. Some investors sold quietly, others waited. Waiting is not confidence, it's paralysis. Multinationals did the math. Regional headquarters had once chosen Singapore because it was neutral, fast, untangled. Now it came with Tokyo alignment, compliance teams updated manuals, legal departments flagged duplication. CFOs asked the unholy question, if we already deal with Japan, why pay Singapore prices? Regional desks shifted functions, not dramatically, one department at a time. That's how cities hollow out, not with layoffs, with reassignment emails. What locals missed. Singaporeans were told nothing had left. GDP numbers looked fine, unemployment stayed low, headlines remained calm. But the quality of capital changed. Less risk-taking, less innovation money, more conservative flows chasing stability instead of upside. That kind of capital doesn't build futures, it preserves museums. This is where you pause and decide. If you want polite optimism, close the video. If you want to understand how money really behaves when illusions crack like this. Chapter 4. When people realized their money wasn't growing anymore. This was the moment everything turned personal. Markets had adjusted, funds had rebalanced, executives had relocated quietly. But regular people were still clinging to one belief. My money is safe. Safe, yes. Alive, no. The era of motionless money. Singaporeans opened their banking apps and saw familiar numbers. Balances were intact. Nothing had vanished, which somehow made it worse. Interest rates hovered just above insulting. Investment products promised long-term stability with the enthusiasm of a funeral brochure. Japanese-style finance had fully arrived. Capital preservation over growth. Risk avoidance as national culture returns so low, they required faith instead of math. Money was no longer a tool. It was a storage unit. Savings became a moral obligation, not a strategy. In old Singapore, saving had a purpose. Buy property, build a portfolio, retire early, or at least earlier than everyone else. Now saving felt like obedience. People saved because they were told to, not because it led anywhere. Consumption slowed, discretionary spending vanished. Restaurants felt it first. Retail followed, services last. The economy didn't crash, it quietly lost velocity. Velocity is what keeps societies warm. Without it, everything feels colder. The Japanese work-life curse crossed the border. Work hours crept up. Wages stayed polite. Promotions became symbolic. People weren't fired. They were frozen. Careers stretched longer without improving. Middle age arrived faster than expected. The worst realization hit slowly. No disaster was coming to reset the game. This was the game now. Property owners felt the trap. Close homeowners waited for prices to rebound. They always do. Except rebounds require growth. And growth had been politely escorted out. Selling meant accepting stagnation. Holding meant watching opportunity cost pile up. Property didn't collapse. It aged, just like its owners. The emotional tax nobody budgeted for people became cautious in ways spreadsheets can't measure. They stopped, changing jobs, starting businesses, having children, dreaming loudly. Japan's most expensive export isn't cars or anime, it's resignation. And this is where the illusion finally breaks. Singapore was never destroyed. It was preserved. Like a perfectly maintained artifact behind glass. Still impressive. Still clean. still admired, but no longer alive in the way living cities are. If this chapter hit a nerve, like the video. Chapter 5. Who actually won? When everything stopped moving. Every system that claims stability is lying to someone. The only real question is, who gets paid for the lie? Winner number 1, institutions that never needed growth. When Singapore stopped growing, the biggest players barely noticed. Sovereign funds, mega banks, state-linked entities with timelines longer than human lives. Flat returns don't scare institutions that borrow cheaply forever, roll debt indefinitely, measure success in decades, not quarters. For them, stagnation is predictable. Predictability is profitable. Retail investors panic at 2% returns. Institutions smile and collect fees. Winner number 2, asset holders who bought decades ago. If you owned property early, congratulations. You're done playing the game. You don't need appreciation. You need rent. Japanese-style systems are heaven for landlords. Prices don't crash. Tenants don't leave, wages stagnate, but housing costs politely refuse to follow. The ladder is gone. But the people already on top don't miss it. Winner number 3, bureaucracy growth creates chaos. Stagnation creates paperwork. Approvals multiply. Committees expand. Risk is managed by never taking any. Careers flourish not by building things, but by preventing mistakes. In this world, innovation is dangerous. Disruption is rude, change is a threat to pensions. Nothing moves. Everyone gets promoted eventually. The losers don't collapse. They fade. The middle class doesn't riot. It tightens belts. Young people don't rebel. They delay life. Entrepreneurs don't fail loudly. They never start. This is the cleanest collapse imaginable. No headlines, no villains, just a future quietly downsized. The final truth. Nobody advertises Singapore was sold to the world as a machine. Japan perfected machines decades ago. What happens when you merge two systems built for efficiency? You remove the last excuse for hope. Why this story matters. This isn't about Japan. This isn't about Singapore. It's about what happens when perfection becomes preservation. When safety replaces ambition. When money exists but refuses to work. When a city survives by choosing not to live.